welcome you with us here in Business Today. I'm Abha Bakaya. Here are the day's top stories. Sensex plunges 872 points with all sectors in the red. More than 6.5 lakh crore rupees in investor wealth wiped out in 2 days. Fears of more interest rate hikes in the US spooking the Wall Street. Rupee hits a 4-week low as the dollar continues its rally on the US Fed Reserve's hawkish stance. Rupee falls 3 paise to close at 79.87 against the US dollar. Markets give a big thumbs up to Adani Group buying DB Power. Share of Adani Power hits the upper circuit of 5%, touching a new high, up 50% in a month. Market cap at 1.67 lakh crore rupees. Is it the right time to buy gold as it hits a 3-week low ahead of the festive season? Find out in our exclusive conversation with Edelweiss Mutual Fund MD and CEO Radhika Gupta. An exclusive peek at Taiwan's Brahmastra, a special ground report from Taiwan on how the island nation is coping with the Chinese aggression and yet keeping the crucial semiconductor supply chain open. British luxury supercar brand McLaren to drive into India. First retail outlet to open in Mumbai during the festive season in October. All models, including the high-performance hybrid or Tura, to be on offer. A rough start for the Wall Street this week. Markets witnessing the biggest fall in over 2 months. After climbing to 60,000 last week, Sensex today tanked over 800 points to shut shop at 58,768. Nifty, which was within kissing distance of 18,000 last week, saw a 200-point dip today, tumbling below 17,500. Markets have been in volatile territory for some time now, but what led to the crash today? Rising dollar and US bond yields ahead of Fed's annual Jackson Hole symposium led to part of the crash. As per analysts, benchmark indices were trading in the overbought zone and they were expecting selling at those higher levels. 45 Nifty stocks were in the red. Metals, financials, some of the top drags today. Tata Steel, Tata Motors, Adani Ports, Divi's Labs, some of the other major laggards in trade. Our global business editor Udayan Mukherjee joining us now. Udayan, after a brief respite, seeing some new levels being touched, it looks like we're back on the downside. Slipping today quite heavily in trade. It's those same old worries that are continuing to crop up again. They're not going anywhere, those recession fears, rate hike fears. What is your opinion on really what markets are reading into currently?
Well, a bout of heavy profit-taking was inevitable, Abha, because the rally has been spectacular. I don't think any of us thought that we would be knocking on the doors of 18,000 on the Nifty quite so soon. So, I mean, if you just see it in perspective, the low was somewhere close to 15,000, 15,200, and we came almost to the doorstep of 18,000 a couple of days ago. That's almost a 3,000-point Nifty rally in the span of just about a month or so. So, the rally has been absolutely spectacular, and therefore, a heavy bout of profit-taking was quite inevitable. And you could see that that was going on as well, even from the domestic investors, because they have been the biggest supporters of this rally. FIIs have also come back to the market, but the biggest support has been from domestic investors. But through the month of August, there has been some selling on the margin from even the domestic investors. And you could see that the first signs of profit-taking from some of the smart money was already taking place after a rally of such magnitude. But I think what has brought matters to a little bit of a head over the last couple of days is those minutes of the Fed meeting, which seem to suggest that there would be many more aggressive rate hikes in the United States. And as a consequence, we've seen the dollar index strengthen once again. The other thing of note is that global volatility had actually subsided very significantly. And if you chart the CBOE VIX, which is the measure of volatility in the US market, that had collapsed to levels of 18 or 19, which is around the level where it typically bottoms out. I mean, the highs were around 35, 36, but over the last couple of weeks that had come down to such low levels that a kind of a spike in volatility was almost inevitable. So if you put it all together, the strength of the rally out here, the notion for profit taking, because as you mentioned correctly, many of the worries have not exactly gone away completely. So the market had rallied, but now we have to deal with some of the old demons once again, and therefore the market's pulling back. Now I think the strength of this pullback or the intensity of this pullback will tell us a lot about the texture of what has happened over the last 1 month. Because often, as they say in the market, the strength of the market is in the kind of pullbacks and whether it takes us back to those old lows or it forms a much higher low this time round. I don't expect the market to go back to 15,000 immediately, but we will see where this pullback takes us, and that will give us a sense of whether this was the real thing or it was just one of those spectacular bear market rallies. Jury's out on that, but I think this will be a very, very interesting phase for the market to watch once the first flush of the profit taking is out of the way.
Well, markets have now succumbed to volatility once again. We decided to decode the current trend with Sunil Singhania of Abacus Asset Management. Listen in to his view on the way forward. Sunil, it's great to see you again. Before we talk about the markets, any discussion this week has to start with thoughts on Rakesh. You've known him for many years, I'm sure. How will you remember him?
Thanks, Udyan and Abha, for having me. So obviously, it's not been a great last week. Rakesh Bhaiya, as we all lovingly used to call him, has been a guide, mentor. I would say he has been one person who has always been instrumental in thinking long term as far as India is concerned. And right from being a very young professional till the time Bhaiya was with us, I think he was always there to guide in his own style and with very, very honest views. So there is a huge void, and I always say that Bhaiya is not there, but his teachings and his words and his umpteenth videos are always there to guide us, and it's all upon us to ensure that we take forward his legacy of being positive on India and ensuring the country does well not only economically but also as far as the financial markets are concerned.
On the market, Sunil, in August we've seen some kind of selling from domestic investors. Do you think this is just profit taking after such a strong rally, or would you read anything more to it? What have you done as a fund manager yourself after such a powerful rally over the last 1 month or so?
If you actually just look back a little bit, this year started with a lot of uncertainties. You had the Ukraine and the Russia issue in February. And just about when the markets were settling in, you had two very sharp interest rate hikes of 75 basis points in the US. It's not that the markets were not expecting interest rate hikes, but the aggressive stance of Fed, not only in the US but also central banks all over the world, obviously took markets a little bit by surprise. And we had a huge reaction in the markets in May as well as the first half of June. But I always say this, and we firmly believe as a company that what used to normally happen in 2 years is nowadays happening in 2-3 months. So the scare of inflation and the interest rate hikes, which normally would have taken 1.5-2 years, sort of got discounted in the markets in like 2-3 months. And by the end of June, you had all the commodities start to react very sharply. You had oil, which had touched 135, 140, come decisively around 90. And I think that was when the markets sort of started to get a whiff that maybe they were building in too much of an interest rate hike, and also inflation might not be as much sticky as markets were expected to be. And you had the rally of, I would say, most not hated but most unpredictable rally of sort, where the Nifty went up by like 2,500 points in a matter of 2 months. One interesting aspect of this rally has been that generally local investors have stayed away from this rally, and it's been predominantly led by global investors who are either underinvested or in fact hedge funds who had also shorted equity in general and Indian equities in particular. And to that extent, I would say the correction from a rapid fall to a semblance as far as the markets are concerned has already happened. In fact, we would be in the camp which were to believe that Nifty would be more or less in the range of like 16,800 to 17,400, at least for the next couple of months, before we decisively start to see stabilization as far as the US dollar is concerned, and ensuingly the commodities. I think what, again, as I repeat, what was happening in 2 years is now happening in 2-3 months. So dollar index has again sort of become a cause of worry. We have already seen, I think euro is almost at par to the dollar, which is after years and years of that happening. And there is a mild sort of a risk off. So at this point of time, I think the domestic investors did not participate in the true sense in the last 2 months, particularly on the HNI side. And there has been some, I would say, tactical takeoff as far as money is concerned. From our side, we have been cautious investors. And to some extent, we would have said, we would have underperformed in this rally because we did not want to play the momentum. But investors continue to be positive, and the flows have been pretty decent even in this rally, though our deployment has been much slower than it was maybe 2-3 months back.
You made an interesting point, Sunil. You said the range would be 16,800 to 17,400. That means that you don't see the market going back anywhere close to the bottom that we made in earlier in the year of close to 15,000. You think that low is in place for the rest of this year?
See, again, these forecasts are always made to be proven wrong. So I would just add that disclaimer. Having said that, I think a few things are working as far as India is concerned. We have had a great normal monsoon again, and the past 3 monsoons have ensured that farm produce as well as the farm prices have been pretty decent. So farm income has been pretty robust. And even from the urban side, particularly on the technology as well as on the financial market side, I think jobs as well as the salary increases have been decent. So despite grassroots level impact of inflation, I think it has got negated by almost an equal or more as far as earnings growth, income growth is concerned. The other thing is, after 3 years, we are heading into a normal festive season. Since 2019, I think 22 would be the first year where we would celebrate Ganpati and Durga Puja and Navratri and Dasera and Diwali in the true Indian fervor, And I think that indication of huge or decent demand as far as, most of the consumption products are concerned is pretty much visible. On top of it, there is a little bit of relaxation as far as I was saying, commodity prices are concerned. And the headwinds which we were facing in terms of margin would start to sort of ease off as far as September is concerned. And that is the reason we believe that on any dips you will have opportunities which will come in. Having said that, Udayan, the world is very uncertain. You not only have the Russia-Ukraine issue, but you have the new China-Taiwan hanging sword. Currency I was mentioning to you, particularly the dollar index is moving, like a yo-yo. 3-4% in a month is like unheard of as far as the dollar index is concerned, but which we are seeing every month. And to that extent, volatility is going to be the order of the day. But given the strong earnings season which is expected based on the strong festive season which we are heading into, and also the fact that income levels both in rural as well as urban India has been pretty decent, I think that should bode well for India. And last but not the least, because of the problems of gas and power and costs which the Euro region is particularly facing, and also the fact that China obviously is one country which the world fears can do something which Russia did. I think India is, if India does play its card well, India can benefit in terms of exports, and we are already seeing that in a lot of sectors, particularly on the engineering side and a lot of our traditional exports. So there are a lot of I would say positives. The only thing is we are not cheap. We are not expensive, but we are not cheap. So we'll have to keep that in mind, and that is the reason whereby we believe that the next maybe a couple of months we should be in that range.
Now, amidst fears that the current face-off between China and the US over the sovereignty of Taiwan may worsen the ongoing global semiconductor shortage, Business Today is in Taiwan, the world's semiconductor manufacturing capital, to check the ground situation. India Today's Gaurav Sawant, who is reporting on the Taiwan-China tension from Taipei, took stock of how the semiconductor chip industry is coping with the tension. Here's his exclusive report from the rarely seen insides of a chip plant at the Hsinchu Science Park in Taiwan.
A semiconductor or a chip. perhaps the most potent weapon in Taiwan's armory, more potent than the F-16 Vipers and the Patriot. And on this show, we will tell you how sand and rock, SiO2, are converted into polysilicon rocks and then a silicon ingot, how bare silicon wafers are made out of this, and how this is then converted into this chip or IC that's used perhaps in most devices in your house, from a mobile phone to a television set to a refrigerator or the aircraft you fly in. By some accounts, majority of such products come from Taiwan.
Gaurav Sawant in one of the most secretive manufacturing plants in the world. The center of technology which makes Taiwan one of the biggest soft powers in the world. This is Semiconductor Manufacturing Unit of Micronix International at the Hsinchu Science Park, 80 kilometers from Taipei in Taiwan. Taiwan manufactures over 90% of the most advanced varieties of semiconductor chips in the world.
We know this is a high tech, and which requires not only the manpower, the mind, the brain, as well as the infrastructure. So, for example, providing a stable supply of electrical powers, water supply, and everything else. Okay. Other than that, I think the entire supply chain. So, for example, the wafer production, the testing, the assembly. So all the supply chain, that's needs a lot of coherence, cooperation in the industry. So in Taiwan, I think it provides a very provident environment to develop all this.
More than 150,000 are employed at this plant. Just 10 miles from Taiwan Strait, where Chinese warships have their guns pointed towards the small island nation. While on the surface everything is calm, there is real fear here of the dragon's aggression. A feeling of nervousness which is spooking electronic majors all across the world. This has led to several countries, including the US and India, to try and shift manufacturing of semiconductors locally to break China's stranglehold around Taiwan.
You can barely see this microchip, but this powers perhaps your mobile phone. Microchips or semiconductors like these also power missiles in different countries. So whether it's your television set or your refrigerator set or the car in your house, semiconductors, by some accounts, 90% are manufactured here in Taiwan. If tensions with China increase, the global supply chain will be adversely impacted. And that's the reason Taiwan is reaching out to democracies across the world. Unless there is a check on China's authoritarianism and expansionism, then global economy may just be adversely impacted. It's time to act now, or it may just be too late. With cameraman Sachin Chandok in Taipei, Taiwan, Gaurav Sawant for India Today.
The rupee was under pressure today as the dollar extended gains to hit a 5-week high. The dollar strengthening after policymakers from Asia to Europe to America promised to keep raising interest rates to tame high inflation. The rupee shut shop at 79.87 versus the US dollar today. Even the emerging market currencies have been on a downhill for the past 2 days. The union government has justified its move to increase windfall taxes on diesel and aviation fuel. A senior finance ministry source told Business Today TV that refining margins had risen more than 200% since the start of the Ukraine war and that the additional tax was justified. The official added that a strong demand for diesel and aviation fuel had precipitated the rise in prices and the margin. The government had last Thursday increased the levy on diesel exports and ATF by 2 rupees per litre. Is gold still a good investment? That's the question we asked Radhika Gupta, MD and CEO of Edelweiss Mutual Fund, which has just launched a gold and silver fund of funds. The yellow metal has failed to give any returns this year. It has not delivered as a hedge investment despite the Ukraine war and galloping inflation. What should your strategy be? Let's take a look.
help us understand about the timing of this fund launch. Like you pointed out, that gold has not, the last 10 years have not been the great for gold prices. Right now, if we see about the near term, gold prices are hovering near a month's low. Also, when many believe that inflation is peaking out, do you really believe this is the right time that one must look at investing in gold and silver via mutual funds?
Yeah, so I think there are two parts to the timing question. One, of course, is that, when we launch funds, we do look at the long-term case because timing is very hard to get right. That said, of course, at Edelweiss, we also try to make sure the timing is at least reasonable. No one can get timing right. One thing that is interesting to note is that the performance of gold and silver is sort of negatively correlated to the dollar index. And with all that's going on in the US, the potential recession that you could see in the US economy, with what's happening in the dollar index, this might be a point of turnaround in gold and silver. So historically, when an asset class has not performed and, the macros are sort of supportive, it makes for an interesting case for a launch.
Okay. Now, just like how you also pointed out very interestingly that traditionally we've seen gold as an inflation hedge, a hedge against other uncertainties. But this year, despite these, all of us seeing the war, the high inflation, gold has really not performed that much. What could be the reasons for this? And do you believe, as many critics point out, is gold really losing its value as a hedge against uncertainties?
No, I think gold's status, and over the last few years, people have challenged gold's status as a reserve currency, particularly with things like crypto coming in. I think this year has validated that, that doesn't exist. I think in really sharp equity corrections, I think gold has done well. This year may be an aberration, but I don't think gold's status as an inflation hedge in itself goes away.
Okay. Like you also said that, you believe that a 5-10% of one's core portfolio should go into gold and silver investment. I want to understand this in the context of millennials. Like in today's age, millennials have, beyond stock markets, they have cryptos, they have REITs, InvITs, they have NFTs, they have Web3, even startups and metaverse to look at. So many new investment avenues. Do you believe the traditional gold investment has that much interest? And should it be a part of a millennials core investment portfolio as well?
I get this question a lot, and incidentally, by the way, I am a millennial, even though I don't think I'm a millennial, but I am a late-end millennial. I think your core portfolio should be simple, and I think whether you're a millennial or whether you're a 60-year-old investor, there are what I always call basic dal chawal components to your portfolio, and those are good quality fixed income, those are good quality equity, and those are a little bit of, gold/silver commodity allocation. I think these are basic core investments that have stood the test of time. 80% of your portfolio genuinely should be this. 20% can be lots of fun stuff. My opinion on crypto I'll reserve for another day, but 20% can be thematic ideas, capital, all of that if you understand the risk. But I don't believe core investments go out of fashion. Perhaps the appeal to a millennial will take some time. We're also, I think, as a mutual fund industry, I'm also vice chairman of MP, we have to keep finding ways to make sure we can make simple products still appeal to a new consumer base. So that's a constant challenge. We're trying to do some interesting marketing with this fund. So let's see how that goes.
That's all we have time for on the show tonight. Thanks so much for watching.